Bah! Investment pet peeves of mine 101. We're going to start with this. Maybe I'll do a list of various investment pet peeves I have. This right here is, it drives me insane. All right. So, hey, sorry about the look here, the appearance. I don't care. I got to get this off my chest. So I'm working with this guy, a nice guy, wealthy individual, done great work for his family, and his kids and whatnot. He got a lot of assets. But the problem is, and it doesn't matter, I see this happen all the time, is that he's got bonds in his taxable accounts and stocks in his tax deferred accounts. Bonds in his taxable accounts limits his ability to do tax planning well. And I'm going to share with you why that is the case here today. All right, so what happens are when you have bonds, what do bonds do? Well, we know bonds don't grow. This is not debatable, my friends. Stop with the idea that bonds grow. But Josh, in 1982, the only reason you got those rates of return because the interest rates were so high. It wasn't because of a capital appreciation on bonds. Stop. Bonds give you an interest. That's it. There's no growth in a bond. The only other way is it could go down because it goes under due to buying a company, Bethlehem Steel or something like that. But there is no growth in bonds. I need to clarify that. I'll say it till I'm blue in the face. Bonds give you no growth. They give you an interest. And you'll get your money back as long as the bond is still alive at maturity. But that's it. There's no growth, no capital appreciation. So because bonds have no growth, that generally means there's not much in losses either. All right. So a bond will stay flat. You get your interest, and then you get your money back at maturity. So no growth, not much in terms of losses, but bonds do offer more in terms of loss potential than growth potential. That's just all there is to it. But at the end of the day, a bond is taxed as ordinary income, or it's tax-free if it's a municipal bond. So people say, well, municipal bonds are great because they're tax-free. I'm going to share with you why that's not the case. It's just not. All right, so a bond doesn't give you much in terms of volatility for capital losses. They don't. They don't give you much in terms of upside for step-up basis. They don't. All right, stocks do. Stocks give you both huge potential, unlimited potential, and we have a downside limits of all the way to zero. Either way, there's benefits on both of those sides. The unlimited potential and upside means that your death, you leave that to your heirs tax-free because of the step-up in basis. However, if that sucker goes to zero, we'll use Bethlehem Steel again. That means you have a capital loss that you can carry forward to offset other capital gains that you may have accrued, or $3,000 a year in income. That there is a value there that you do not get in stocks. You get an upside, huge upside potential. And just use the example, I had a lady back in the same guy actually bought Apple very, very cheap back in 1998. I'll never forget this lady. She was in Tennessee, and she just took a flyer on Apple, paid $7 a share for it. I think she bought, I can't remember, 100 shares, something like that. And it's worth, the last time I talked to her, it was 5 years ago, it was worth like $400,000. So she paid, we'll say $10,000. I really have no idea, but $7 a share at 100 shares, 200, I can't remember. We'll just say $10,000. She paid $10,000. Is worth whatever it was, $500,000, whatever, I can't remember, but just using that example, that $400,000 odd of gain at her death will go to her heirs, her husband, whatever it is. She wasn't married, but it doesn't matter. It'll go to whoever she deems it completely tax-free. All right, that's good. Now, if Apple, on the other hand, if she would have paid $10,000 and went to zero, that $10,000 she can use to offset other income or other capital gains. So there's a value on both sides of that equation. Now, conversely, if she would have put that Apple in an IRA, it doesn't have any value whatsoever in terms of the taxability, because what happens now is not only does the IRS owns 25% of that because she has required distributions. So she took 100% of the risk, but is only getting 75% of the gain because of the RMDs and the tax, the income tax that is due when she takes distributions out. She leaves that to her heirs. They got to pay tax on that. So she took 100% of the risk and doesn't get 100% of the gain. On top of that, if the Apple she would have bought in an IRA went from $10,000 to nothing, there is no tax write-off. She can't take a tax deduction because it's in the IRA. All right, so on top of that, in this case, we have Apple stock. Let's just use that for an example. So my man's saying he's getting more in dividends annually on his Apple stock than what his initial cost basis was. I'm like, holy crap, it's flipping awesome. That's exactly what we want. The municipal bonds, though, don't do that. The municipal bonds, if you put $100,000 in there and you get 2.5%, that's $2,500 a year tax-free. Whip-de-flip-and-do. 20 years ago, that's $2,500. 20 years forward, $2,500 tax-free. So you're not paying the income tax, but the Apple dividends now, let's just say you bought it for $10,000 and now you're getting $10,000 of qualified dividend income. That's taxed at 15%. It could be taxed at 0. It could be taxed at 20, whatever your tax bracket is. But you're getting, so remember, you put $100,000 in a municipal bond. You're getting $2,500 a year tax-free income. You put $10,000 in Apple stock. Now you're getting $10,000 a year of qualified dividend income tax at 0, 15, or 20%. Which is better? On top of that, the Apple stock, because it's gone so high in value, you will transfer to your heirs. And if you live in a community property state, the West Coast, your spouse will get that tax-free because that's how community property works. On top of that, even worse, let's just say you had, I don't know, a government bond fund, and you put $500,000 in a government bond fund. We'll just use that for an example. And let's say it's paying, you bought it when the 10-year treasury is at 3%. All right, so now you get $15,000 a year, completely taxed as ordinary income. All right, you're paying 100% ordinary income tax. There's some benefits to the state. I get that. I just, in this stage, I don't care. So you're paying $15,000 a year in taxable. Taxable income is $15,000 a year taxed at your capital gain, tax as ordinary income. Which would you rather have? Would you rather have dividend income or ordinary income? Dividend income, qualified dividend income, or ordinary income? You'd much, much, much rather have qualified dividend income or long-term capital gains because they're taxed lower than your ordinary income tax bracket. And every circumstance, that's the case. If you're in a 12% or lower tax bracket, ordinary income is still taxed at 10 or 12%. If you're in a 12% or lower tax bracket, qualified dividends and long-term capital gains are taxed at big fat goose egg, nothing. If you're in above a 12% tax bracket, every single penny at 22, 24, what's the next one? 33, whatever it is. If you're in a 22, 24, 33% tax bracket, qualified dividends and long-term capital gains are taxed at 15%. Ordinary income is taxed at 22, 24, 33. If you're in the highest tax bracket, I think it's 35 and 37, qualified dividends are taxed at 20%. Ordinary income is taxed at 35 and 37%. Every single instance, qualified dividends are taxed much, much, much more favorably and long-term capital gains than our ordinary income. What is a bond? It's ordinary income. What is a long-term capital gain and a qualified dividend? It is tax favorable. I don't care if you're Mr. Burns or if you're Joe friggin' Chimney Sweep. You get better tax treatment on qualified dividends and long-term capital gains than you do on ordinary income. Every single case, that's the truth. Every single case. Plus, you get the ability for upside gains, so that way you can leave it to your heirs completely tax-free under the step-up basis rules. Plus, you get the ability to write it off if it goes down to 0. It's a huge pet peeve of mine. Huge. And the problem, and I don't get why. I just don't get it. I mean, I get it. You know, ignorance is bliss, and some of these financial advisors out there don't know their freaking butt from a hole in the ground. I'm just sitting there thinking, you've got to look at the big picture of the tax planning. You've got to see what is causing me more taxation. What's causing you more taxation is your asset location. Your asset location. Having municipal bonds, which pay me a pittance. Having ordinary income bonds, government or corporate bonds in a taxable account. Having high growth stocks in an IRA. We want to flip that over. Yeah, it kills me. All right, part 2 of this was, I had something else on my mind. I was going to say, there's another point of this. Hold on just a sec. I got to think about this. I'm drawing a blank. Hold on a sec. Part 2 of this is tax loss harvesting. And I emailed this guy. I said, I have a sneaky suspicion tax loss harvesting is only taking place in December. Now, tax loss harvesting, my friends, is when you sell a stock for a loss in order to offset gains in the future. All right, or gains income today. So remember, going back to a $10,000 example with Apple. I bought Apple for $10,000. It goes to pot. I have a $10,000 capital loss. I can use $3,000 of that against income. All right, so if I have $3,000 of income, I now have no income at all because I can use $3,000 of that capital loss to offset against ordinary income. I still have $7,000 which I can use against other capital gains which I have. All right, so that's what tax loss harvesting is. Let me sell a position that's lost value in order to lock in the capital loss. There's some debate in the financial planning intellectual air about if tax loss harvesting is worth or not. At this stage, it doesn't matter. It is what it is, and that is an opportunity for you to offset other gains with the losses, for sure. Not to use that. I don't get that. Now, what I hear all the time is people say, well, I'll wait for it to come back to even. So I bought Apple at 10. It drops to 5. I'm not going to sell it. I'll wait for it to come back to 10. I'll sell it then. That's I hate to say that's stupid. Don't do that. Apple stock doesn't know what you bought it at. It doesn't know. It doesn't care. It doesn't know who you are. It doesn't know your cost basis. It doesn't know anything about you. It does not care. The markets don't care about old Josh. The markets just care about the next trade. That's it. The trade in the past is completely irrelevant. So sell that sucker, lock in those losses, but don't wait until December. That's when everybody does it. What a good tax planning is tax loss harvesting throughout the year because things go up and down throughout the year. I'll never forget in 2006, was it 16 or 15? I forgot. Small cap stocks had a 33% decline in like April and May of 2016, all the way throughout the summer. Man, you should have been selling them suckers like crazy. You should have been on the horn with your broker or on the internet with your own firm and just saying, sell, sell, sell. Let me lock in a freaking 33% decline. I'll wait 30 days. I'll go back into the position. You should have been on that like white on rice. If it's in an IRA, it doesn't matter. But don't wait until tax loss harvesting day. It's like it's like, oh, a broker's called. Now it's tax loss harvesting day. It's like a holiday. So December means tax loss harvesting days. Losses happen all the time throughout the year. If you bought something at $100,000 and now it's, what is today, June something, June 19th, June 17th, and now it's worth $60,000, why would you wait till December? Sell that sucker. Lock in your $40,000 of losses. That can be used until you die. Don't wait for tax loss harvesting throughout just at the end of the year. Look at your statements. Go online. What is my cost basis? What is my realized or unrealized gain? Is there any opportunity to liquidate something? Yes, then freaking do it. Don't wait for your broker or your CPA, for heaven's sake, to do that. CPAs aren't going to be doing this. They're too flippin' busy. You need to take charge of this. So you look at your statement and say, I got some tax losses on a gold fund I bought. The gold's got hammered. Let me go ahead and sell that sucker. I'll wait 30 days, and if I still like the idea, I'll get back into it. That's called avoiding the wash rule. You got to wait 30 days. So just to be safe, wait until the next month. All right. That way you can't sell a position, repurchase that position within 30 days, or else it's called a wash. That means you don't have a tax loss, so you can offset it because you have a tax wash. It's a loss. You've violated the tax loss rules. So you got to wait 30 days. All right. So let's just say you bought XYZ stock at $100,000. It falls to $60,000. And you sell it, you lock in that $40,000 loss. 10 days later, it's up to $70,000. You're like, I better buy that again because it's moving, and you buy it. Well, you just lost that loss. You can't use that $30,000 loss anymore. Or I guess $40,000 because you violated the wash rule. So you got to say, no, I'm waiting for it for the day 31. I'll get back into there. That's what you got to do. You got to wait. So just if you're going to make a sell it now and wait 30 days and get back in the position if you want. No big deal. But people always wait till December, and I've never understood that rule. I don't get it. Well, I do. Look, I come from the brokerage industry. I know what happens. People are looking for ways to generate revenue. Brokers are. I'm telling you, I've seen this happen with my own very eyes. What can we sell to create a commission to lock in the loss in order to buy something to create a commission to take advantage of the losses? I'm just telling you right now, this happens all the time. So here it is, December. Hey, Mrs. Smith, remember that product I recommended to you? Yeah, well, that didn't work out like we thought, but at least we can sell it, and I can take that $5,000 loss and offset some of your other capital gains. Well, that sounds great, Joe. Bob, Josh, that you're looking out for me. And then little unbeknownst to Mrs. Smith, does old Josh get a commission? I'm selling the fund to you to begin with, and then the back end of selling it at a loss. And then of course we're gonna have to use those proceeds to maybe buy that same position 30 days, which I get a commission there too. Anyway, tax loss harvesting. Do it now. Look at your accounts and say, hey, is there anything I can take for loss? Sell that sucker. All right, that's pet peeves 1 and 2, I guess. That's 2 pet peeves for the price of 1. So don't forget to subscribe. Don't forget to smash. I'd love to hear your own pet peeves. Let me know what you got. If you hire a financial advisor, is that guy or lady on you like white on rice to sell stuff at a loss, or they just wait till the end of the year? Hell, and don't be relying on your CPA. They're not going to be doing this. I'm telling you right now. Reality is your money. No one cares about your money more than you. So make sure you're the person leading the charge. All right, we'll see you next time.